Good morning. Thank you for joining. I can't believe it's 2024 already, and that we're already 2 weeks into January. So what can we say about 2024? Well, for those of you who follow the Chinese calendar, 2024 is the year of the dragon. We all love dragons. For movie buffs, 2024 is the setting of the sequel to Highlander. I don't know if any of you remember. It's a sequel best forgotten, but Highlander 2 is set in 2024. But most importantly, 2024 sees over 3 billion people in 40 countries worldwide going to the registers to vote. So I think 2024 is going to be defined by geopolitics. Already so much has happened. The UK and the US have launched airstrikes on Yemen. China has published new draft gaming regulations, and Taiwan's ruling DPP party won a third term last week. So lots to look at, lots still to come, but let's dive in and see where we are. So let's look at performance since I last met with you. This is performance over the last 6 weeks, so from the beginning of December until yesterday. And as you can see, a lot of the December euphoria has retraced in the first 2 weeks of January, but things are still looking good. And in particular, interest rate sensitive stocks, which rallied really hard on the Dovish Fed, are still looking solid. Property stocks up nicely. You can see there global property up 6%. Small caps, in particular, Fourth Industrial Revolution Fund, up 5%. But generally, everything up very nicely year to date. The standout disappointments are China, certainly. China down nearly 8%. And that's on the draft gaming regulations that it put out. And I'll talk more about that in the China sector, the section later on. South African equities also the second worst performer, down 2% over the last 6 weeks. And that's mostly due to commodity prices, which are down sharply. In particular, platinum is down a lot over the last 6 weeks, but also some SA specific risks that have come to the forefront again. And I'll talk more about those in the SA section. Gold has also not done as well. It's down 1% over the last 6 weeks, along with the US dollar. And that talks to just generally a slightly more risk on environment after the Dovish Fed. And I certainly will focus a lot on that being the big defining event that's happened over the last 6 weeks, the December FOMC meeting. But backed by popular demand, a look at the top performing Sygnia funds over the last month and the last year. So this is to the end of December, so that we have a full month's number. So 1 month of December 2023 and the 12 months to the end of 2023. So looking at 2023 as a whole, saw phenomenal returns. I mean, the best performing stock in the S&P 500 in 2023 was NVIDIA, up 239%, just phenomenal. Second best was Meta, up 194%. So the AI stocks certainly, and the FANG stocks certainly took the prize pole position for 2023. Technology, not surprising, was the best performing sector in the S&P 500 for 2023, up 56%. So it's no surprise there that if you look at the 12-month performance, that the FANG fund, the Sygnia FANG.AI equity fund, is nearly doubled over the last year. That's just awesome performance. Some of you will remember that fund used to be called the Sygnia FANG Plus Equity Fund. It was renamed FANG.AI towards the end of last year, the same time we launched the ETF, which tracks that unit trust. But those stocks, the good news about the AI stocks is that they are so large, those FANG stocks, that they make up a significant portion, not just of the FANG index, but of the S&P 500 and of global world indices. So the MSCI World, which you can invest in with SIG World ETF, or the Sygnia iTrix S&P Global 1200 ETF, which also invests in the S&P's version of MSCI World. Those have significantly large exposures to the Magnificent Seven or FANG stocks. And you can see there that the developed markets as a whole were up very strongly on the back of those stocks. So second place being the MSCI US, third place was S&P 500, fifth place, as I said, the Global 1200 ETF, just slightly beating MSCI World. In fourth place was the Euro Stoxx 50. That mostly bounced off a low that it had at the end of 2022, but also very nice returns. So strong returns over the last 12 months from developed market equities. Emerging markets not looking as good. South African equities looking terrible over that period. And then looking at the 1 month, as I said, it's all about the Dovish Fed and the rebound in the interest rate sensitive stocks. And you can see that very nicely with the South Africa listed property index up 9%. That's a phenomenal return from our South African listed property sector, which was still negative over 12 months. So very much bouncing off lows. The Sygnia Fourth Industrial Revolution ETF also doing very nicely in December as small caps rebounded. Divi Fund in South Africa also did nicely. The Divi Fund was a bit of a surprise because resources struggled in December, which kept the South African market down as a whole. And the Divi Fund is still overweight resources because that is where the highest dividend yields are currently sitting. And some of those resource stocks are looking incredibly cheap on 1 and 2 spot PEs. But the fund still had a nice return in December, up 5%. Global property up 4% in terms of the ITRIX ETF, and health innovation up 3% for the month of December. So these numbers don't quite correspond to the previous slide, because the previous slide was 6 weeks from the 1st of December to mid January, where this is just looking at the December number for 1 month and the 12 months up to the end of December for the 12 months. So those are our top performing funds, very much reflecting what the market has done over the last month and over the last 12 months. Then as a once off, we're going to be repeating this each month, but just to share some of the Sygnia investment team's top picks for 2024. Something for everybody. For the AI enthusiasts, the pick is Supermicro. It's an IT company that provides important hardware for the production of AI chips. So basically, if you want to sell shovels to the gold miners, then this is the one for you, where you can invest in a company that supports the AI industry. Yeah, definitely looking very interesting. For the anti-ESG enthusiasts, anti-ESG, not ESG, we have Evolution, which is a leader in online gaming software. It develops, produces, markets, and licenses casino solutions for online casino operators. We all know that online gambling is certainly quite a defensive play, like alcohol and other addictions. It does well no matter what's happening. So in a slowing growth environment, probably a defensive position to have if you don't mind being anti-ESG. Then in third place, Longy Green. That is for the renewable enthusiasts. It is one of the largest global solar producers in the world, but it's looking incredibly cheap right now just because of the negative sentiment towards China. So in China, there's some interesting stock picks that are certainly standing out because everything has been sold off. China as a whole is looking incredibly cheap because earnings have actually held up. But it's just the PE that has derated with all the negative news. That PE pricing in much lower growth over the next 5 and 10 years in China. But that does mean that there are certain companies that in the EV space and the renewable space that are looking quite attractive. And Longy Green is one of those. So if you're brave and you're happy to take on some China risk, then Longy Green is worth looking into. Pfizer, one of my favorites. I do love the healthcare sector. Healthcare sector was one of the disappointing sectors in 2023. I think with inflation likely to stay higher for longer, it's still our outlook, and interest rates higher for longer than the market is forecasting. I think that pharmaceuticals and healthcare is defensive, and certainly Pfizer is looking oversold and an attractive play on that sector. So for the healthcare enthusiasts, have a look at Pfizer. And then lastly, for the private equity enthusiasts, have a look at Scottish Mortgage Investment Trust. that should benefit not only from a strong rebound in the technology stocks, but also private equity companies as a whole have been trading at a big discount because of high interest rates. And as we see interest rates start to be cut in 2024, that discount should narrow quite nicely, and that could lead to some interesting returns for Scottish Mortgage Investment Trust. Now, what I haven't put on this list is all the more interesting stock picks, or let's say stock picks, but picks from the investment team. One of them is certainly crypto and Bitcoin, for example, on the back of the fact that a lot of the team were anticipating not only the halving that's happening later this year, but the fact that the SEC was likely to approve the spot Bitcoin ETF. And they did this past week. The SEC approved spot Bitcoin ETFs, and BlackRock was first in with their ETF. And there was a lot of excitement and people expecting that Bitcoin would rally as a result of that new demand for Bitcoin through the ETFs. And that was one of the reasons why Bitcoin has rallied so strongly over 2023. In fact, it doubled in 2023, some very, very nice returns. I'm not as excited about Bitcoin in 2024 as my colleagues. JP Morgan put out a very interesting report. They expect this new ETFs, the new Bitcoin ETFs, to attract at least $36 billion. However, they expect that $36 billion to come solely from existing existing Bitcoin holders. And they say the biggest arbitrage is going to be this grayscale ETN, and that's because of fees. So the grayscale is currently 150 basis points, and the BlackRock ETF is being priced at 25 basis points. So unless Grayscale cut their fees dramatically, we're expecting, or JP Morgan are expecting, a big flow. Nearly 2/3 of that 36 billion is coming from movement out of Grayscale into the cheaper BlackRock ETF. And then at the same time, a lot of direct holders who hold crypto in wallets on exchanges would probably prefer to go move those holdings into the ETF with better security and a more regulated environment. So they are expecting big flows into that ETF, but not expecting them to be new flows, and as a result, not expecting too much of a price increase. Like what they're saying is, yes, there will be some new flows into the ETF, but there's been a lot of speculation ahead of it, and so the net not too much of an impact on crypto this year. But I've been wrong on crypto before, so maybe you shouldn't take my word for it. But certainly very big development with the approval by the FEC of the spot Bitcoin ETFs. Of course, they're also distancing themselves. On one hand, they're approving it. On the other hand, not doing, cautioning that it is dangerous. Sygnia, we are still keen to launch our own ETF. As many of you know, we tried about 5 years ago and didn't get approval. At that time, it was a debenture structure. We are trying to launch a proper ETF, a crypto ETF. We still are in negotiations with FSCA and the JSE. We'll keep you posted. Hopefully, this ruling by the SEC does lead to some change of view from FSCA and the JSE, but at the moment, still no ability for us to launch an ETF just yet. So watch that space. We certainly are focusing on it, and maybe we'll have an interesting offer for the Bitcoin enthusiasts who are looking to get some alternative exposure in 2024. So that's the Sygnia stock picks and fund performance. Let's look at macroeconomics and our outlook and positioning for the environment. But let's start with the chart of the month, and that is definitely this chart. So this chart is the FOMC dot plot, and that basically shows the median interest rate expectation of the members of the Federal Open Market Committee. So basically, where the US Fed expects interest rates to be over the next 2 to 3 years and the long term. So it's a bit of a complicated chart. Sorry, the Fed doesn't make anything easy. But if you look at the purple, that was the FOMC members' projections at the September meeting. So on the 20th of September, they put out their forecasts, interest rates in 2024, 2025, 2026. In blue, the blue dots represent the median of the FOMC members. They dot projections that they put out at the December meeting, so 13th of December. And you can see there that the lines just join the median. And it's a bit hard to read, but if you just look at 2024 on the x-axis, you go up that dotted gray line, you can see there that the purple dots represent the September meeting, and the blue dots represent the December meeting. And you can see there that the median, or the central point for those dots, has dropped from 5.125%. And that was the September expectation. So the Fed in September last year expected that the year 2024 would end with interest rates at 5.125%. And they dropped that in the December meeting to expecting that the 2024 year end interest rates would end at 4.625%. Basically, what that means is the Fed went from saying there's going to be one cut in 2024 to 3 cuts in 2024. Now, this is very, very, very important because it's the first time that the Fed has actually decreased their expectations of rate cuts. So they've always had, they forecast hikes and they forecast cuts, but that dot plot, ever since they started hiking interest rates, that dot plot has been moving up and up steadily each meeting as inflation was a concern, or as they were concerned that investors weren't taking them seriously. And this is the first time that they've actually reduced that dot plot. So it marks a serious inflection point. And not only that, but it was amplified by Fed Chair Jeremy Powell's comments at the press conference. So very, very, very dovish statement, the dot plot, and very dovish press conference. So what does that mean? It means that we've interest rate hikes have peaked, and while we haven't actually had a physical cut yet, we are on our way to cuts, and the Fed has obviously seen that we're over the hump, that they've done enough to curb inflation. So that's very, very important for markets. And it did lead to a huge rally in markets in December on the back of the November rally, when we had some decent inflation numbers, some inflation that surprised the downside. So let's a great December rally. Some of that has retraced, as I said, the first 2 weeks of January. And unfortunately, the downside of having a very strong December on this very dovish news is that some of the gains that we were expecting in 2024 have moved forward to 2023. The good news is that we went overweight equities on that dovish announcement. And so we captured not all, but some of the upside that happened in December. And that certainly worked well for the portfolios into the end of December. And the funds had a really great December. Now, we still remain constructive on risk, and we are overweight equity for 2024 , but risks remain because there's heightened volatility, there's geopolitics. As I said, 2024 is likely to be the year of geopolitics, as well as the year of the dragon and the year of Highlander 2. And that could lead to a lot of volatility. In particular, as I said, these dot plots point to the Fed projecting 3 cuts in 2024, but the market is pricing in 6 cuts. So while overall it's a constructive view and everyone agrees that interest rates are going to be cut, that pace of interest rate cuts is certainly out for debate. And we'll see whether the Fed moves down to 6 or the market moves up to 3 as data comes out. But more likely, our view is that the Fed is right, and we're probably going to be higher for longer. And there will be some disappointment probably in property stocks and small cap stocks throughout 2024, or at least over the next couple of months, while the market reprices this risk. And there's still a lot of people out there who think there's going to be a recession. And so one of the reasons why the market is pricing in 6 cuts is because a large portion of the market is projecting a recession in 2026. And those people who are projecting a recession, they're probably pricing in 10 cuts. whereas the people who are going for a soft landing are saying 3 cuts, and you get to an average. But that overall view is leading to the market being more dovish than the Fed, and that's going to lead to some volatility. So certainly, to me, this is the key chart over the last 6 weeks, and the key feature that we will continue to monitor very closely, along with every inflation number that comes out of the US and every jobs number that comes out of the US, and how that impacts markets. So that brings us to the most recent jobs number. And here we see US Treasury Secretary Janet Yellen, who, after the surprising jobs number, and you can see how surprised she looks in her photo, she was certainly surprised by the job number, and she boldly declared, and this is very unusual, but she boldly declared that what we're seeing now, I think, we can describe as a soft landing. So a very strong and bold declaration by the US Treasury Secretary that there's no recession in the US and they're heading for a soft landing. Now, yes, the job numbers that came out that she was talking to certainly speak and support to the fact that we're in for a soft landing, and we believe that we're in for a soft landing. But there's also a lot of data that contradicts that, and also points to the fact that wage inflation is not necessarily a huge risk, and that we're not going to see a second wave of inflation. So a lot of views out there. On the one camp, you've got US recession, 10 rate cuts. On the other hand, you've got people saying, oh, the Fed's now too dovish, and there's going to be a second wave of inflation because of wages, and the Fed's going to have to hike rates. But we're somewhere in the middle, where we think that inflation will continue to fall, and the US will have a nice soft landing. So let's have a look at why we believe that. There's definitely going to be a slowdown in growth in the US. Why? Well, because pro-cyclical fiscal policy, the tailwind from fiscal stimulus, that's coming to an end. We also have shown you many charts in the past about the huge amount of pandemic savings, those excess savings that occurred during that COVID. Those have to a large extent been spent, and definitely high interest rates are going to impact with a lag. So growth is going to slow. I'm not going to argue with that, but we are on the soft landing track and not the recession track. Why? Well, for a number of reasons. Firstly, financial conditions have improved. Basically, interest rates have been cut, which makes it makes money cheaper. Secondly, business confidence and consumer confidence are still holding up nicely, so people are still spending. They still feel that they can spend. And this is on the back of very strong balance sheets. Both US businesses and US consumers have very robust balance sheets, and they can afford these high interest rates that have come through, and it's going to carry them through into the rate cut cycle. Yes, house prices will fall, but unlikely to fall dramatically like happened in 2008, because there's a lot more limited supply, and we haven't got the same distortions that we had in subprime crisis of 2008. And finally, while job openings are falling, unemployment has not been impacted yet. And yes, unemployment will eventually tick up, but our base case is that this is a rather unusual cycle. And it's rather unusual because of all the distortions that have happened from COVID. And COVID has certainly led to not only distortions between lockdowns and spending on products and spending on services, but it's also led to a distortion in terms of managing productivity. And we have seen a rebound in productivity, and managing employment. Because now you can work from home, you can work part-time, you can have 2 jobs, you can work a couple of hours, and employment has become a much harder thing to measure. And I think that as we work through some of these COVID distortions, it's going to allow employment to tick up without the US going into recession, at least for the next 6 months, and that's as far as our outlook looks. And more importantly, what's going to help drive this positive sentiment in the US is that deflation is going to continue. Most importantly, we had some strong inflation this past Friday. Past Wednesday, we had inflation numbers come out in the US. They did surprise the upside a little bit. And that was on the back of a strong consumer, which is a good thing. But also core was mostly supported by shelter inflation. The chart on the right here, if you have a look, you can see there that this is This is a projection by the San Francisco Fed, their model on shelter inflation. And you can see there the purple line, they're forecasting shelter to plummet dramatically. And within the next 18 months, shelter will be at -2%. And that's going to keep core inflation in check and falling very strongly. So based on the San Francisco Fed, shelter inflation will keep core inflation in check, which will allow the Fed to keep cutting rates, at least 3 rate cuts this year, and that will keep the disinflationary, the soft landing on track and disinflation on track. Oil prices are also falling. Yes, there is some risk to the upside because of geopolitics. I'll talk about that later, but for the moment, oil prices are holding steady. And in particular, even if there is a rise in oil prices, if you look at US petroleum prices or gas prices, those are falling quite dramatically because of a narrowing in margins at US refineries. So not only is the oil price and Brent falling, but the gas price in the US is falling even further because of that disinflationary number coming through from US refineries. So what the US consumer is spending is certainly falling pretty nicely. And then, as I mentioned, productivity improving. We've had a decade of disastrous productivity, and then a very nice bounce in Q3 of 2023 of US productivity up beautifully. And that lowers the unit labor costs. So even though wage inflation is going up, after you subtract productivity, wage inflation is below 2%, which is important. Now, productivity is one of the things that it's very tricky to measure, and very tricky to understand if that bounce is going to continue. But there is some evidence that unlike the last decade, where the major driver of technology was social media, which didn't necessarily help productivity. In fact, there are some reports that social media made productivity worse. AI, on the other hand, or at least looking at ChatGPT and tools like that, are improving productivity. And companies that have adopted those large language models and AI are certainly seeing an improvement in productivity, and that should help that productivity number stay positive. But it's difficult to measure, and we'll have to see. And then finally, 2024 is an election year. By the geopolitics, we've got Biden currently leading the polls, but it's neck and neck. Trump is still leading the Republican is still the leading Republican nominee, and that's obviously going to lead to some very interesting volatility in the US. In the past, US markets have done better when the incumbent wins, but I think we have to worry about causality on that. I think there might be that the incumbent is more likely to win when the economy and the market is doing well, than the reverse, that markets do well because the incumbent is likely to stay in. I mean, surveys show that Democrats are ahead, so maybe it's a bit of both, but we'll be watching that closely as well. I mean, on the other hand, Trump doesn't hold back any punches, and he's already saying that if the Fed is dovish this year and they don't hike, or if they cut rates too much, then the Fed is supporting the Democrats, and he's waving his finger and calling for an unfair advantage. So maybe the Fed, instead of being driven to be dovish because it's an election year, they might be less dovish because Trump puts on pressure. But who knows? We'll have to watch that space very closely. But again, a lot of volatility. So bottom line, we remain overweight the US. Even though the US is incredibly expensive. It's the most expensive it's been relative to Japan, relative to Europe, relative to developed markets, relative to emerging markets in 20 years. So that is, we are aware of that, but certainly that is where the momentum is for the moment. Now, looking at the markets, it's very interesting to see that you basically have 3 pillars driving global equity performance. On the one hand, you've got Magnificent Seven, and the performance from Magnificent Seven has been phenomenal, been driving global markets as a whole. And to the point where the market cap of the Magnificent Seven is now larger than the GDP of every country in the world, barring China and the US. But certainly, those companies are doing incredibly well, and they're likely to continue to do well. Yes, they are expensive, but they've got huge moats. They've got huge client bases. It is so easy for them to roll out new products to their clients, for them just to add new clients. They've got such huge balance sheets that they can buy competitors, that they can easily spend money on R&D and roll out new products. That's why the FANG stocks were able to harness the power of AI so successfully. It's just they are well positioned, and nothing is going to take that positioning away. So it's hard to say that those companies aren't going to continue to do well. The biggest risk is antitrust. But at the moment, that seems to be taking a backseat. Maybe in an election year, there will be some antitrust pressure to break up the Magnificent Seven stocks. But at the same time, they are seen as national champions, and they are, the US winners against China, and certainly that tech race is very important. Ironically, China, and we'll talk about it later, are very worried about antitrust, and they are breaking up their companies, and they're more worried about the consumer than they are about beating the US, which is ironic, but certainly is weighing on the Chinese market. So that brings me to the second pillar. So the Magnificent Seven is one pillar that's been driving markets. China is the third pillar. That has been an absolute tragedy. China's stock market has collapsed. We sold out of China in the middle of last year because of a lack of bazooka stimulus, and they've done a lot worse than we thought. We thought they'd be bad, but they've actually done a lot worse. And I'll talk about that on the next slide. And then in the middle, you've got the rest of the world. And interestingly enough, the US, or the S&P 493, so basically S&P 500 less than Magnificent Seven, the US 493, Europe, and Japan, those developed markets have all been trading roughly in line with emerging markets ex-China. So everything else, China on the one hand is a bit of disappointment, Magnificent Seven on the other hand doing incredibly well. Everything else pretty much muddling along, not great returns, but pretty much sideways movements over 2023, and they're looking fairly priced. So we could see some nice gains out of those stocks if growth holds up as we expect, and interest rates continue to be cut, although we are expecting interest to be cut less than we expect. So an interesting outlook, but for now we remain overweight the US. What could change our view? Well, on the one hand, we could get excited about China and EM and the developed markets that are reliant on global trade, like Japan and Europe, if there's bazooka stimulus in China, but not seeing anything there yet. On the other hand, something that is important to watch, and I'll be talking about it next webinar, because I don't think it's going to happen in the next month, is small caps and interest rate cuts. And maybe when is the time to move out of the quality of Magnificent Seven into the more risky small caps? So certainly that is something that we're watching, and I'll talk more about that next month. That is a big call. We did see that big move in December. Small caps rallied massively, property rallied massively, but a lot of that's already been unwound in January, and I think that there will be this volatility. And it's something that we have to watch closely. So the February, watch out for the February webinar where we'll be talking more about small caps. Okay, so that was the one pillar, Magnificent Seven and the US. The other pillar, which is disappointing, is China. So jumping from US exceptionalism to the Chinese tragedy, we have President Xi Jinping talking about high quality development. That's something that he rang the new year in and has been broadcasting that statement all over the place without giving too much detail of exactly how that is going to be achieved. So we are also watching and waiting. Unfortunately, when it comes to China, it's a case of too little, too late. Chinese exports fell in 2023 for the first time since 2016. China's inflation is on the longest downward streak in a decade, so a deflation environment. And again, that's one of the reasons that it's supporting the rest of the world with inflation, surprising to the downside. Chinese consumer and business confidence remains depressed on the back of the property crisis and on the back of insufficient fiscal support and because of a slowdown in global exports, and that talks about friendshoring and everyone trying to move away from China and investing in Mexico and Taiwan. Although a lot of that comes back to China indirectly, but not all of it. But the biggest concern, this talks to the chart on the right, is the Chinese property prices. Again, it's something we've spoken about, that property prices are the highest in the world. If you look at Shanghai, so that's that dot. So this chart goes back down to the 1970s, and it shows the price to rent ratio across various countries. So if you look at the green line, that's Tokyo in 1991, and that talks to the Japanese property crisis that burst in the early 1990s, and that led to basically 3 decades of disinflation in Japan. Japanese equity markets barely recovered back to those levels, and there is a lot of comparison between Tokyo, Japan 30 years ago and China now. Then you look at the purple line, that's New York, the US in late 2000s, and Spain, Madrid in late 2000s. And that talks to the subprime crisis, which took down Europe and the US. Not nearly as high as Japan, but still very high. What is quite concerning, because no one's talking about it, except for me, I have definitely mentioned it in a few webinars, is the Australian and Canadian property prices. And in particular, you can see here, Sydney 2022, I mean, that's the highest, excluding China, the highest in any other major city in history. And yes, those Australian and Canadian property prices have come off quite dramatically, but even so, still looking incredibly expensive. And we could see some headwinds in Australia if and when those property prices do cool. Shanghai, definitely the worst, and we know China is a bit different though, because and I'm not saying that this property crisis isn't going to weigh on China. It certainly has, and one of the examples is that China's just seen the biggest ever bankruptcy in its history, one of the shadow banking giants that filed bankruptcy this past month. But at the same time, China's got the highest savings in the world. And when you do have a very high savings culture, it does offset that debt to some extent, and they can weather those slowdowns a lot faster. In fact, what China needs to do is just improve consumer confidence and get some of that cash invested. And that will, and either into the stock market or into the property market, and that will help China recover a lot faster than other economies have in the past. But so far, that Chinese consumer confidence and Chinese business confidence isn't recovering. And one of the reasons, again, is the Chinese regulations. China started its collapse not only on the back of the property crisis and the property bust, but on the massive amount of new regulations that were promulgated 2 years ago, and particularly focused on the education sector, online education and online gaming, and that detracted from foreign investment in China and foreign investment confidence in China. Now, China's been doing its best to try and win back those foreign investors by talking to corporates and doing roadshows and saying that they will never repeat what they did 2 years ago, and they will listen to corporates and they will listen to investors. And then in December, what did they do? Without any consultation, they put out a draft regulation on gaming companies that was incredibly punitive. And the gaming companies, Tencent in particular, fell dramatically. Naspers fell 18% in one day. Now, they have learned from the mistake, because they quickly pointed out that this was a draft set of regulations. It wasn't final. And that companies do have until the 22nd of January to reply and comment on those regulations. And not only that, but in the subsequent week, that gaming authority approved over 100 new online gaming names, which is the most they've done in the past year. And in a sign that they might have made a mistake, the government official who put out that draft regulation was fired. So yes, they've tried to distance themselves from their own goal, but it hasn't really worked. and that faltering consumer confidence and investor confidence that was slightly recovering has been decimated. And those companies, they fell. They did bounce about, they recovered nearly half their losses, but they're subsequently nearly back at their lows. I do think it's overdone. I do think it's oversold, and I do think there's some upside. There's definitely that those companies are solid companies, just like the US FANG stocks, Alibaba, Baidu, Tencent, solid companies. Yes, there are some growth headwinds, but I think that they are oversold in the short term at least, and we're expecting a bit of a bounce. And when we talk to our active South African equity managers who hold Naspers, all of them, every single one of the 5 that we hold in our active equity funds, they're all overweight Naspers and Prosus, and all believe that this was a good buying opportunity. So I think there is some upside to SA equities as a result of Naspers and Prosus, and to China. But that said, we aren't buying any China yet. We have enough exposure indirectly through South Africa, and we definitely think that the headwinds more broadly for China are in place until we see some bazooka stimulus. So not doing anything in China just yet. And unfortunately, China's slowdown more broadly is a reflection of global trade slowdown, which does impact Europe and Japan indirectly as well. So it's a part of the reason why we're overweight US and underweight Japan and Europe, and certainly why we have no China. Another one-off slide that we're going to be talking about today is COP28, the 2023 United Nations Climate Change Conference, and that was certainly disappointing. In fact, Professor Michael Mann of the University of Pretoria said that it was devastating. And here he's talking more about, or in particular, specifically talking about the fact that instead of talking about phasing out fossil fuels, the Climate Change Conference said that they're only going to transition away from fossil fuels. That was unfortunately a step back in terms of the climate change and renewable agenda, and devastating according to one scientist. And it's no surprise that the conference was a disappointment. In 2023, China connected the highest number of new coal plants in history. And the US oil production hit the highest level of any country in history. So that is quite incredible. The US now a net exporter of oil, and certainly not reliant on the Middle East for oil, but definitely a surge in dirty production. And we understand why. People are moving away from Russia, and even with the Middle Eastern crisis, that means the US is upping its own production, and energy security has resulted in renewables not only being supported as a move away from Russia and the Middle East, but also in an interim while we're waiting for those renewables to be put into production, a rebound in dirty energy. And 2023 saw the hottest year in record, the hottest 12 months on record, and the warmest year in the 174 years that we measured that period. And that takes you to the chart on the right, global mean temperature difference. You can see that the 1.4% ahead of the long-term average, and the steady incline of that chart as average temperatures every year gotten warmer and warmer and warmer. Now, yes, there's still a lot of scientists that don't believe in climate change. Certainly, I believe that you look at the climate volatility, that is on the rise. And I think that is unlikely to change. And unfortunately, one of the things that was looked at the conference was the first comprehensive assessment of progress under the Paris Agreement, and that highlights that current efforts are not enough to limit global warming to 1.5%. So we're sitting at 1.4. The aim was to limit it, that it doesn't rise at 1.5. Unlikely to get there. And I think that the impact, whether you believe in climate change or not, is certainly more volatile weather patterns. And there's no denying that we have seen a lot more volatile weather patterns. And that's going to lead to a disruption in a number of things. Storms, we'll see the closing of ports. Floods, we'll see the damaged infrastructure. Droughts, we'll see crops decimated. All of that is going to impact the supply of food, the supply of energy, the supply of goods, and not only impact global food security, but also inflation. And I think we are in one of the risks for 2024, not only is geopolitics, but enhanced weather volatility as a result of these rising temperatures, and just the fact that we will see bigger swings in what is happening. So while not directly investable, certainly something that will lead does support our higher volatility thesis going into 2024. Moving on to South Africa. Here we have Dr. Anthony Turton, who's talking about the release of the 2023 Blue Drop water report. And he says we are in deep crisis. And there he's talking to the fact that 90% of South Africa's wastewater works are dysfunctional. Not only that, but 46% of the water supply system in South Africa is undrinkable. And that just talks to no service delivery. And we've got a number of corporates in South Africa who are forced to not only provide their own water supply, but they are also using that water supply to provide water to neighboring communities. So South Africa is stuck on this lack of service delivery, a big concern as we go into elections of 2024. And not only are corporates having to provide water, but corporates are having to provide water to communities that surround them, just as corporates are having to fill in potholes in the communities around them and power traffic lights in the communities around them. So lack of service delivery is something that that is weighs heavily on South Africa, and so much pressure is being placed on the private sector to do whatever they can to try and keep literally some of the lights on and some of the water going. But looking broader than water, Eskom's system status outlook for 2024 is dire. They are predicting every week of 2024 in the red. That's the worst case on their system outlook, and that's over 2,000 megawatts that are going to be a shortfall in 2024. And we've seen that stage 4 already to the start of January. Then looking slightly wider, PetroSA wants to partner with Russia's Gazprom bank. And as we all know, that bank is under US sanctions. So that's not a great tie-up, because if that does happen, it's going to lead to a lot of Western suppliers and partners pulling out of South Africa. And what is more concerning is that there were the other 19 bidders, every single one of the other 19 bidders. There were 20 bidders, all the other 19 were disqualified under unusually strict criteria. So something looking a bit dodgy there. Then we had government announcing a new nuclear procurement process of 2,500 megawatts. But again, in September, NERSA put out a set of specific requirements they needed to get from Eskom before they would approve Eskom to announce that process. And NERSA have not, they have not shared that they have received anything. So things happening without transparency, maybe with no support at all. The State Attorney's Office has sent an inquiry to the Department of Home Affairs asking why the visa backlog continues to grow. It's something that's been highlighted by Cyril over the last 2 years, that there's a lack of skills in South Africa, and the easiest thing to fix is just to fix that visa administration to get that skill sorted out. But have we seen an improvement? No, it's actually getting worse. Not only that, but in 2023, 2,525 applications for mining rights and permits have been received by the Department of Mineral Resources and Energy. Not one of them has been looked at. So that is another failure of service delivery. One that's a bit quieter because we don't quite see that happening, but that's direct impact on employment, because if companies, foreign and local, aren't getting investment, they can't create jobs. And foreigners and locals aren't going to, they literally can't invest without permits. So, we're doing ourselves no favors. Companies don't have electricity, companies don't have water, companies they aren't getting the skills they need because of visa backlogs. Companies aren't getting permits approved. Literally, so many own goals that it's just absolutely, it's a tragedy. It makes the Chinese tragedy look like a comedy, a Shakespearean comedy, but still a comedy. So, which we remain underweight South African equities. We are neutral South African bonds because the yield is still decent. And we still have some big risks that come up. We've got elections, as I mentioned, and some big risks that we could have announcements, pro some unfavorable policies that are announced before the elections. And we've got the budget in February, and that budget is going to look tough. We certainly, we saw in the medium-term budget policy statement that we're way behind budget, and there's a tough budget announcement in February. So, some key risks on the horizon. No service delivery, which means no investment in South Africa, which means no job creation, which means no improvement in exports, which means the rand is not going to get any support. So things are certainly looking grim there. I'm going to put a little product plug just on this dire outlook. We are in the process of launching a pro range, which is a maximum offshore balance range. So please keep an eye out on that. And that's basically, we currently have this, we have a Sygnia, a signature range, a range of balance funds. We've got the skeleton range, a range of balance funds, and they all have, in line with their risk profiles, varying amount of offshore. But we're launching another skeleton range and another signature range, which are sitting at maximum offshore. Which means they're not perfectly aligned in the short term from a risk return profile, but for those with long-term views who think that that there's no chance that this is going to ever improve, well, it's just something for you. But it's definitely a range of products with a much longer-term time horizon, because the rand can recover in the short term, not because of anything we're doing, but commodities. Again, not only am I going to talk to small caps at the next webinar in February, in 3 weeks, but I'm also going to talk to commodities. And commodities are incredibly oversold right now, and there is, the speculation is the lowest it's been in nearly a decade. If commodities do recover, again, in the short term, well, we could see a nice bounce in emerging markets. We could see a nice bounce in the rand, and a nice bounce in resources in South Africa. So again, this pro range is more of a longer term focus, and there is potentially some upside to South Africa in the short term, depending on your commodity outlook. So sign in for next month's webinar for small cap versus large caps and commodities outlook. Some interesting things happening there. While I'm talking about the webinar for next month, it's tax season, so Marius is back. You remember from last year's webinar, and he's going to be giving some tax advice ahead of the end of the tax year, February tax year end, and so that's another thing to look forward to at next webinar. Small caps versus large caps, resource outlook, and Marius will give you some insights and advice and some good ideas what to do with your holdings ahead of the tax year end. Okay, so that brings us to the end. Just summarizing our positioning. So where do we stand? We're overweight the US, we're overweight global, overweight the US, underweight everything else, neutral global bonds, neutral South African bonds. Why? Well, because the US, certainly we're expecting it's going to be resilient, and it's well positioned for a soft landing. Despite lagged effects of monetary policy in 2024, we think growth will slow but not stall. Inflation will slow, but interest rate cuts, improved productivity, global product disinflation from China, strong household balance sheets, strong business balance sheets, strong consumer confidence in the US reduces the risk of recession. Same time, China needs huge government fiscal campaign to revive growth and global trade and commodities. which is all unlikely. So for the moment, we're comfortable being underweight China, emerging markets, Japan, and Europe. US bonds are looking fair. I mean, we're not overweight US bonds, but for the first time, they're looking fairly priced. Yes, they don't give you the same yield. So on a total return basis, if you've got a 10-year view, you probably just want to hold emerging market bonds, or at least South African bonds for South Africans, because you're getting much better running yield. But if you're worried about risk return, and balance funds are all about risk return, for the first time, developed market bonds are giving enough yield to warrant the fact that if there's a recession, they will give you some protection. So if there's a recession, US bond yields could fall from 4% down to 3%. And that helps to offset the negative returns on equities. So we are neutral bonds, developed market bonds, not because of yield, but because of a risk outlook. But at the same time, only neutral on South African bonds, because South African bonds don't do that well in a risk-off environment, because the rand sells off and then our bonds sell off. So despite the fact that US remains expensive relative to history, we remain overweight the US within our global equity allocations. The dollar is the big wild card. With the US cutting rates this year, we could see a little bit of dollar weakness, but two things talk to dollar strength. One is the fact that the US is still the strongest economy in the world, and that gives them an ability to cut rates slowly, whereas Europe might be forced to cut rates faster than they want to, and that interest rate differentials will just keep the dollar slightly stronger. And the dollar can't really rally without the rest of the world growth being stronger than US growth. So without a Chinese bazooka stimulus, or at least US interest rates cuts supporting the rest of world growth, the dollar is not going to rally. So my view, if you had to put a gun to my head, and I don't like having a gun to my head because my crystal ball is a bit murky, but it would be a euro dollar outlook of somewhere between 110 and 105, 110 on the weaker side, when things are looking that US is going to cut rates a bit faster than expected, or global growth is a bit better expected, and then on a risk-off scenario, maybe down to 105, but not big ranges on the dollar. That said, there are lots of reasons for risk. So yes, our default is tight range on the dollar and overweight the US and overweight US equities, but there are some big risks ahead of us in 2024, but not our base case, but risks that could disrupt our base case, certainly geopolitics. And some of that can lead to higher inflation prices, through higher inflation through higher oil prices. So the one we are watching very closely is the Houthis' attack on Red Sea shipping, and that's seen shipping prices in the Red Sea that have skyrocketed to 300% in the last 2 months. That's definitely a concern for inflation when shipping prices rise 300%. As a result, we saw the UK and the US launch airstrikes on Houthi targets in Yemen, and that definitely raises geopolitical risks. Right now, we don't see that escalating further. We don't see that being a major risk, but certainly oil prices did rally 5% on that news. They have retraced that mostly, but there's definitely, we have always been watching Israel and Gaza. This is linked to Israel and Gaza, but definitely small flare-ups in the Middle Eastern tension could lead to higher oil prices. Similarly, flare-ups in Russia-Ukraine could lead to high energy prices, which lead to high inflation, and that could disrupt our base case scenario. Not only that, but as I mentioned before, 2024 was a bumper year of elections, 3 billion people heading to the polls in over 40 countries, and that could see some short-term volatility if those elections are more populist than we are hoping. We have just over the past weekend, we've seen the Taiwanese elections, and there, unfortunately, that raises tensions between the party the incumbent party that stayed in are not big fans of China, and that raises the tension and risk between Taiwan and China. Again, our base case is certainly no military war between China and Taiwan, that heightened tensions is certainly not something that will improve investor confidence into either China or Taiwan. So another reason to be worried about emerging markets is just people just rather avoid it because of that heightened risk, unless it looks incredibly cheap. And there is some value out there, but value can become a value trap and can last a lot longer than we like. Or more importantly, can last a lot longer than our clients like, and that is a big cause for concern. So, bottom line, definitely, we are pro risk. We went overweight early December. It did help our portfolios, but we are monitoring the risks very, very closely. There's a lot of key risks that could happen with elections and geopolitics and even weather events, which can't be predicted. So we may change that view quite quickly. But for now, we remain overweight the US and overweight overall. And that is a wrap for the January webinar. Thank you so much for listening. Thank you so much for joining and for trusting us on your outlook for the markets in 2024. So let's move to Q&A. Okay, look at some questions. Kobus says that he has read a few articles suggesting a recession or even a depression like the 1930s can be expected. Is this a reason to worry? There are some strategists out there. So two of our favorite strategists are bank credit analysts and Alpine Macro, Bank BCA. They are forecasting a recession, although definitely nothing like the 1930s. The 1930s was a depression, not a recession. Whereas Alpine Macro are on the soft landing camp. In fact, they are so bullish on growth that they're overweight emerging markets. So, we're somewhere between those two views. I haven't seen any. Obviously, you've read articles. I haven't, but I don't see any reasons to be concerned about a 1930s depression. That is just highly unlikely. For that to happen, you need some wild card geopolitical event, which is could happen, another war. But I can't see any central bank pushing interest rates to push economies into a recession, let alone a depression. And 9 out of 10 recessions are caused by central banks raising interest rates. So that's not our base case. Second question from Kubus: does the Sygnia unit trusts offer sufficient protection in case of a sharp market decline? Kubus, that all depends on which of our range of funds that you are invested in. Definitely, if you're invested in any of our 100% equity funds, those funds could fall 20% on a recession. In general, the rule of thumb is a bear market, which is linked to recessions, 20% drawdown. But if you're in the skeleton balanced fund, well, the fund targets no negative returns over 12 months, even in a recession. Or if you want to go even more conservative, there's the skeleton. There's the enhanced income fund, Sygnia Enhanced Income Fund, which is currently got a yield of nearly 11%. That fund has no bonds, no property, very defensive. So if you are worried about a recession, you can get an 11% return right now, running yield with very little risk. If you want a bit more risk, skeleton balanced absolute. Or if you want to be on the more conservative end of our relative funds, then Signature 40 or Skeleton 40 or Skeleton Balance 40, they have 40% equity, and you get some upside, but you could have slightly negative returns, maybe 5% down over the next 12 months if there's a recession. So you've got the full range. And based on your view and your risk appetite and your time horizon, you pick what suits your strategy. Serena asks, any view on the timing or launching of the Sygnia multi-currency platform? Serena, we're full speed ahead on that. There is some good news on our online platform, which I can't share top secret, but there is some good news on our online platform, which will hopefully come out soon. And then once that platform is launched, multi-currency should follow after that. And as soon as multi-currency is available, then we can bring some very exciting dollar-based products to our investors. So just watch that space closely. But yeah, we're talking 6 to 12 months, be my guess, and please don't hold me to that, because when it comes to development, people have been hurt with predictions. Mike asked the same question. Timeline on the new online platform. Yes, it was expected November last year. It's some good news on the way. Please keep posted. We should have some good news in the next few months. We'll hopefully. Good question from Mr. Niko, who says that the December inflation aside and more to come. Yes, certainly the US CPI number was a bit disappointing. It surprised the upside. The Fed focuses on core PCE, so we're more focused on that number than the CPI number. It's also just one number, and we do think that that inflation will continue to fall. But that said, we are concerned that the market is pricing in 6 cuts, not 3 cuts, like the Fed is, and I think that although we think that inflation will fall and interest rates will be cut, there's currently a 50% probability being priced by the market that there's a March cut. That's not our base case. We think maybe even September only for the first cut. So we'll wait and see. Elodie says, Kyle, what is your outlook on the recovery period for emerging markets? Do you think it is a reasonable strategy to reduce current exposure to emerging markets and switch some of the funds to property ETF? I think tune in for the webinar next month, because our outlook on commodities will impact that, and our outlook on small caps will also impact that. It's very hard to say. Certainly, emerging markets are looking very cheap. Small caps are looking very cheap. Commodities are looking oversold. But right now, the trend is slowing growth, which is not good for commodities or emerging markets. And right now, the trend in China is just no turnaround or no bazooka stimulus. So, I'll give you more details on that. What I generally say, and I know this is a cop out, and I do apologize, but is to do things in tranches. I do think that if you look at, I don't want to steal the thunder on interest rate cuts, but on a 12-month view, we could see some improvement in small caps. And certainly, I do like the healthcare market. You did ask about that. So we could see a rebound in property and small caps over the next 12 months, and healthcare remains defensive. But do you want to sell emerging markets? We don't have any exposure in our balance funds, so maybe sell a bit, do a tranche, and see what happens. In the short term, always a difficult one. Sorry, I know that's and not a definitive answer, but it is difficult. Just reading a comment by Mr. Niko. Yes, I agree with you. John, thank you for the request. He asked if Sygnia is going to launch a high yield US ETF. It's a good question. It's something that we will add to our list. We do continually review the funds that we have. Right now, if you wanted to look at high yield, the highest dividend yield in our ETF space is currently the UK. There's some juicy dividends coming out there. And then ironically, is China. China's currently got nearly a 5% dividend yield because earnings have held up and prices have just collapsed. But I'm not suggesting you invest in that as an alternative to US dividends. Alternatively, there is on the life license for your RA or LA, we do have the Berkshire Hathaway Fund, which is a the quality value play, which there are some, they do have not necessarily a high dividend yield, but they're sitting on a lot of cash in that fund. But no, we don't have a high yield US fund, and we'll definitely look to do that. Chris, I'm sorry if I missed a slide change. Wayne says, do you see the potential stimulus in China leading to demand for SA commodities and hence upside for resource stocks? I'll talk more about it next webinar, but certainly stimulus, if there was strong stimulus from China, and they did announce something again, they keep just dribbling out stimulus. They announced something again today, but until there's like a strong bazooka, but put it this way, if there was suddenly a massive stimulus coming out of China, definitely people get excited about commodities and excited about resources. When it comes to resources, I think, and we are going to do a deep dive into this. I'm not sure if it'll come out in next month, but maybe in the future. Definitely resources are being very hurt by the China slowdown. China is the biggest user of commodities in the world. I mean, for most commodities, they consume about 2/3. That said, a lot of those commodities also go into renewables, whether it's renewable infrastructure or electric vehicles or parts for power plants, and all of that could see some support to the demand for infrastructure, so demand for resources in 2024. So watch that space. Where are we? This is another good point from Mr. Nika. Thank you. Please, a reminder to everyone, please, if you're going to put questions through, just don't put them through as anonymous, just so I can see what questions are linked to what questions. Louise says the Sygnia Pro range, is this for discretionary investments? Good point, Louise. We're not going to, it will be, well, we're not going to launch a new range of unit trusts. It will be on the life license, so it will be available for discretionary investments through endowments or retirement annuities or living annuities. So yes, it's a yes for discretionary investments, but a no for the unit trust avenue. For unit trusts, we've still got skeleton balance 70, which has 40% offshore, so it's very close to the 70 Pro that's going to come out, which will be at 43% offshore. So you can get very close to that with the skeleton balance 70. You all know it, my favorite fund, skeleton balance 70 unit trust, the default unit trust for discretionary investments, the default regulation 28 fund for people with long-term time horizons. So please. Yes, Peter asks, is the Pro range going to be Reg 28 compliant? Yes, it will be Reg 28 compliant. So it's going to be a maximum offshore within the Reg 28 framework. So I should have said that. So it's going to sit at offshore, which will sit between 43 and 45%. We can't have it sitting at 45 because then it'll breach every day. But we'll start at 43 and let it drift, and then bring it back to 43 when it gets close to 45. But the Pro range is designed to be a maximum offshore Reg 28 fund across the risk spectrum. So whether you want 40% equities, 50% equities, 60% equities, 7% equities, whether you want passive, skeleton, or signature, which has some active, you have the full range of options. So 8 new funds that we are launching there, all Reg 28 compliant, or available in RAs, LAs, and discretionary investments through endowments. Mike says, please confirm you're underweight Japan. Mike, we're probably neutral Japan and more underweight Europe. We're close, yeah, to be precise, but probably a slight underweight Japan and a neutral Europe. The only fund that is overweight Japan is the World Flexible Fund. That has got a little bit of Japan, but again, only slightly overweight. Louise asks, why does asset subcapacity not impact unit trusts? Or why does asset swap capacity impact unit trust and ETFs. So as I said last time, please help us help you. The more assets we get into our unit trust manco, that brings our overall level down to 45, and it creates capacity so that you can invest into our global unit trusts, such as FANG or healthcare, or our equity fund of fund, international equity fund of fund, or international flexible fund of fund. That differs from the ETFs because the ETFs actually run through a separate manco, or at least that there's separate regulations. So our ETF manco is allowed 100% offshore from a SARB limit, whereas our normal unit trust manco has a 45% limit. So there actually are different limits and different regulations that apply to those two different mancos, and that's why that is the case. So yes, our ETFs can never be capped. Our ETFs will never be closed, and that is why for our capped funds, so I think the healthcare unit trust is capped, but you can invest in a healthcare ETF, which will never be capped. And the I've drawn a blank, but the Fourth Industrial Revolution unit trust is capped, but the Fourth Industrial Revolution ETF will never be capped. But as we get capacity into our balanced funds and our domestic funds, that will we could see an opening of that capacity. So yeah, please help us help you. If we don't see any inflows, then we may have to close and cap more of those funds. So I think we've only currently capped 3: the healthcare unit trust, Fourth Industrial Revolution Fund, and the Worldwide Flexible Unit Trust. I think we may be forced to cap FANG and international flex, and possibly even international equity, if we don't see some domestic flows. So yeah, again, we will be putting out some great reasons why you should be investing in enhanced income. It's a great defensive place, 11% yield in a low growth environment, or our money market fund, our skeleton balance absolute fund, or even skeleton balance 70. It all helps create capacity for the manco. Okay. Janine, good question. Must be switching out of emerging markets. It depends on your time frame. Depends on your outlook for commodities. It depends on whether you think China is going to bring through a bazooka. We don't have any emerging markets in most of our balanced funds. You could, if you are concerned about the outlook, you could do some tranches and see how that goes. The big question about, it's very easy if you don't hold anything, because you only have one decision to make. That's when to buy. If you currently hold, your question has to be, well, okay, I sell now, but when do I buy back? So it's 2 decisions, and if you do decide to sell, you have to watch it very closely so you don't miss the re-entry point, and that is quite makes it a more difficult decision than just buying. But overall, we do believe in diversification, have a diverse portfolio. Japan, Europe, emerging markets showing a lot of value, just some headwinds. Dave says, which Sygnia funds include the stock picks of the year? Dave, none of them do. So, we don't have any direct actively managed funds that we pick stocks specifically. We have our FANG fund, which is an actively managed unit trust and actively managed ETF, but it's more on a thematic basis. So we find sectors and themes, and we invest in those stocks that support those themes. Similarly, with the Fourth Industrial Revolution. So there are some funds that hold some of those stocks, but not all of them. And those are just our investment teams' best ideas for themselves that they've come across, and for the stock picking enthusiasts. But no, I should have reinforced that those stocks don't necessarily reflect Sygnia's view. They certainly don't reflect any Sygnia funds. Some of our funds might hold those stocks by accident or through a theme, but not because of their stock specific view. But definitely, we may hold some of them because of an AI view. We may hold some of them through a thematic view, like healthcare. But yeah, we certainly don't have a thematic anti-ESG view, for example. Although I have seen some anti-ESG funds out there, and performance hasn't been too bad. There's definitely in the short term when ESG funds have collapsed on the back of Tesla falling. Chris says, can you comment on the best ways to protect individual investors against hyperinflation scenarios? But Chris, hyperinflation is not something that is a base case for us in South Africa. It's a very different outlying risk. I mean, the best way if that is your view, then you want to get as much money out of South Africa as possible. So you can invest into any of our global funds, any of our ETFs that have 100% global exposure, or any of our unit trusts that have 100% global exposure. And basically you want to avoid South African rand exposure. Jacqueline, thank you very much. EP, good question. Is China's GDP still closing the gap on the US? When is it predicted that China will become larger than the US? So 2 points on that. One is, are you looking at dollar GDP or purchasing power parity GDP? If you look at the second, China is getting very close to the US. However, whereas it was actually expected to cross the US in 2 years' time, because Chinese growth has slowed more than expected, and the US growth is actually more resilient than expected, that has probably been pushed out from 2 years to 5 years. But it's still something that we expect to happen in near term. And it is one of the reasons why, that you have to keep an eye on China. Yes, China, a lot of people are concerned that China is not investable because it's not a free market. And there are a lot of risks, but at the same time, China has never been a free market. Those risks have always existed. China has rewarded investors at times, just as Japan, looking at the last 30 years, has doubled, probably about 3 to 4 times. So there are times when you do want some exposure to Japan in a deflationary environment, or China in a non-capitalistic view environment. And just because, anyway, you have to keep an eye on China because they're such an important part of the world. They're still, I think I mentioned, they provide 90% of chips that go into PCs. So anyone who has a PC, laptop, or a normal PC, 90% of those chips come from China. So and likewise, cell phones, majority of cell phone chips are still produced in China. So China's not going to go away. It's still a very important part of the supply chain network, and very important to keep an eye on. And just right now, don't have any exposure. But we still have our China ETF. And there will be a time where we take a tactical view on that and go overweight it. For people with very long time horizons, maybe you want some exposure there. Rishi, yes. Once we have multi-currency, we will be able to have exposure to dollar funds, and then we will facilitate moving rands into dollars and providing offshore bank accounts, but we can't do anything until we have our platform can help us do that. Francois, yes, a very good point. He says, do our ETFs avoid withholding taxes in the US? Not all of them, but we do have certain facilities in place where we do get some of the withholding taxes back, the best that can be done. So definitely our ETFs and our unit trusts, we are very aware of withholding taxes, and we do maximize the recovery of all withholding taxes that is possible. So Francois, great question, great point. Sygnia is on it. Not only do we keep our costs as low as possible, but we make sure that your net return, net of tax and net of costs, is as high as possible. So yes, we do pay someone, provider, to make sure that we get those withholding taxes recovered for you to the best extent possible. Derek says, what is your outlook for Japan? Japan, it's very difficult. I could have a whole webinar on Japan. I prefer Japan to Europe. Europe is still being plagued by Japan. Europe's more reliant on emerging markets and emerging market growth. Europe's more dependent on the current Red Sea issues, with ships going through the Red Sea. Europe's more dependent on Russia and Ukraine risks. So there's a lot more risks in Europe. Europe's also still while it's a monetary union, it's not a fiscal union like the US is. So I prefer Japan. Japan, it's got a lot of positive stimulus right now. There are definitely reasons why you could be overweight Japan right now. But I'm more neutral on Japan, given the fact that it is still, more of a cyclical play. They're still very much geared to global trade, which doesn't do as well in the slowing market. But they are a lot more defensively positioned than Europe right now. So I prefer Japan to Europe, but not as much as the US. And it's definitely cheaper. So if you're looking for more of a value play that doesn't have as many headwinds, Japan could be there for you. Derek asked, the fourth industrial revolution has not performed over the last 3 years. I'm starting to see it improve lately. Am I a bit confused? Do you think the fourth industrial revolution will improve and compete with the new AI ETF? So, Derek, we've taken the view, as I've said for a long time, that we do think that we're in a higher for longer environment, and that means that the small caps won't do as well, and the Magnificent Seven will continue to do well. I will talk more about small caps next month, the next month's webinar. There are definitely some strong reasons why you want to start looking at small caps. But to basically summarize it, we don't think there's a balance there yet. And certainly in our unit trust, the ETF is a passive fund and it tracks the Kensho index. The 4th unit trust is an active fund, and certainly we have transitioned to more of a large cap bias in our unit trust, in line with our view that we do think that that large caps and the Magnificent Seven will be more defensive and more robust into this growth slowdown, and interest rates are cut, but not cut as fast as we expect. But I'll definitely give you more details on that next month. Wayne, yes, Wayne said scope for OSI, but it's now OSE. Wayne, yes, certainly there should be an OSE, Sygnia OSE newsletter coming out soon. I'm not sure exactly when. I'll have to follow up with marketing. But the bottom line is private equity as a whole has done terribly over the last 18 months because of rising interest rates. Now that we're into a falling interest rate environment, that does look more promising. It's kind of linked to our small cap view, which I'll talk about next month. But I think in addition to our small cap view, there's been a definite resurgence in the focus on healthcare. Now, as I said, healthcare stocks have done, just listed healthcare stocks have done atrociously over the last year. Healthcare is looking a lot as a whole in the listed space is looking a lot more exciting in this year, and that's already seeing a lot of focus happening in the unlisted space. And OSE is probably 70% healthcare focused in the unlisted healthcare space, and some big M&A happening over the last month. And I do think that there's going to be a lot more M&A happening in that space. So we are quite bullish on OSE. Again, like our small caps, nothing's going to happen in the short term, but our healthcare outlook is improving, and small caps, over a 12-month view are definitely improving. So OSE hopefully has also seen an inflection, not maybe more of a slower recovery, but hopefully we've seen the worst. Leon, any comments on India? Leon, India looking great. India's performance has been incredible. As I said, EMX China has done very well, has kept up with Europe and Japan and other developed markets. A lot of that's been led by Mexico and India, but it's also looking quite expensive. We don't have any direct India exposure, but in our emerging market 50 ETF, we do have India exposure, and the outlook on that is positive. It's a bit like US. It's expensive, but it's probably one of the more defensive EM plays. So if you want to take picks, short-term picks on emerging markets, India and Mexico definitely currently have the momentum behind them, even though they are expensive. Okay. How are we for time? It was 12. Okay. Only a few more questions. France. Yes, because the Pro range is Reg 28 compliant, and the Pro range only has 45% offshore. The Pro range won't ever be capped in the living annuity space, so you can invest in the Pro range in living annuities without any issues. So that would be great. Please do. Henry, the pro range will be implemented before the end of February. So please keep a look out for that. And it will be available for tax-free savings. Yes. It should be available for tax-free savings. Definitely the skeleton version is where there are no performance fees. With the signature, where there is performance fees, there won't be, but definitely there will be. The skeleton version of Pro Range should be available for tax-free savings accounts in an endowment space. And on the life license. John, hopefully I've answered your question on Japan. Japan continues to do well and has done well. It's done incredibly well in yen, but obviously the yen's been incredibly weak. So on a dollar basis, Japan's just done averagely, but yeah, it has done a bit better than Europe. Adrian says, why do we limit offshore exposure in living annuities? Same thing. So we have a unit trust Manco, which is measured as a whole, and that is at the 45 limit. And we have on the life side, we have a life Manco, if you want to call it that. It's probably not the right word, but we are limited in our life license to how much retail offshore exposure we can have, and it's also 45%. And it's the same thing. If we get money into our money market fund or a low offshore fund on the life license, it creates capacity for our offshore funds. So same story there. Why there are caps there as well. Yes. Good point from Mr. Naka again. Again, he says, if offshore markets outperform South African markets and the rand weakens, both of which have happened, it naturally, just for your existing book, it makes the existing book say, if we had if 40% of our Manco in the unit trust space and the life space if they were sitting at 40, a weaker rand moves them to 42, and strong global equity exposure takes it to 44 relative to. So unfortunately, that just from a flow perspective, get closer and closer to those limits. Which is why we certainly aren't the only company that's capped. Alan Gray's capped, Coronation's capped, 91's capped on certain funds. So it's a big issue that the industry is facing because South African equities are underperforming because the rand is weakening. So every time the rand weakens, we're forced to cap more funds. It's a very sad set of affairs. Again, we are engaging with the regulators, but it's unlikely to change anytime soon. But it is why the industry is facing this, why are we facing this, and bottom line is it sucks. Pleasure, Dave. Clive, that's a good question. I'm not sure what exchanges those the Sygnia investment team stock picks. I'm actually not sure what exchanges they're all priced on. I think they're mostly priced in the US. They're either US DSRs or London DSRs or London Direct or US Direct. Pleasure, Henrietta. Lloyd, no idea. Nico. Nico, on the crypto, I don't think so. I think that I can't see the crypto ETFs leading to a massive amount of new flows. I don't see it being a big risk for the dollar or for gold for that matter. Maybe on the margins, but I'm not seeing a big move either way. Okay, that's all our questions. Thank you everybody for joining. So thank you for staying for the full 90 minutes. I hope that I've answered all your questions. I will see you soon. The February webinar is on the 7th February, so it's not too far away. I look forward to seeing you all again and discussing all that has happened. And hopefully we have some more positive markets, or at least a recovery in markets before then, and some more good news to tell you. Until then, keep well.